Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, November 7th, the day after the U.S. midterms and those results coming in just hours ago. I've been up far too long overnight, and if I get incoherent at some point, hopefully one of my co-hosts will take over here. But a pretty long night, but not a huge market takeaway. I've got a chart here of Eurodollar sort of showing the back and forth. We had, the general tendency was for the dollar to weaken if it looks like the Democrats are doing well. That appears to be what the initial sort of surge in the exit polls were showing. And then Eurodollar dropping lower as it appeared Trump might be edging forward. There were a couple of key Senate races and these so-called toss-up races, especially in the Senate, that started leaning clearly Republican, and I think the market trying to take a bigger takeaway there. But that changed later in the night as the weight of the Democratic popular vote really clearly came in, and it became very clear that the House was going to go for the Democrats, while even though the Senate is, the Republicans have solidified their majority in the Senate. I've got just a rundown here on this slide of just some really basic, the basic facts of the elections. We had, again, these statewide elections, so those for the Senate and those for individual state governors, generally leaning Republican, and the Republicans making actual gains in the Senate, so an actual widened majority there. 54 looks like the number there out of the 100. Popular vote very strongly Democratic. At one point I saw before the votes were all tallied something like a 9% margin, a 9-point margin in favor of Dems, and that means they have the House majority. It's there. It's not overwhelming, however. It's around 20 seats. So within the realm of the consensus expectations. The protest vote that really swung things in the other direction for the 2016 result was suburban voters mad at Trump perhaps on the housing interest deductions aspect of the tax reform, and then women that were voting anti-Trump for obviously for other reasons. Takeaways. What does it mean for the market? What does it mean for policy? This is something we could discuss for many minutes, much less just a brief rundown of bullets. But I think the general idea here is a few takeaways we have. First, Trump's big deregulation drive could be partially hampered, although you could argue, and Peter and I were discussing this before the broadcast, that gridlock is generally good for not at least preventing new regulation. But I would suggest that his aggressive deregulation could be hampered by a democratically controlled House. Then we have this subpoena risk. Many of these committee chairs in the House will be switched to Democratic control, and as the chair, you are able to subpoena information, subpoena the president for documents and other things without having the committee's majority approval, which could mean things like subpoenaing Trump's tax returns and any real estate dealing documents, etc. I think this would be an angle the Democrats could take to try to take down Trump in PR terms. I don't think they'll be mounting a big impeachment effort. I think that's too controversial. Plus, they don't have the Senate anyway. Back to our list here. Again, impeachment risks somewhat minimal. The Mueller investigation, I'm not sure that's going to go anywhere. Mueller is not popular. People see this as a very politically motivated investigation in the first place, especially independents seeing it that way. And then I think the general tilt is we have populists. Trump is a populist. The Democratic opposition is going to find traction by being populist as well. That's going to mean higher risk of fiscal deficits, not lower risk. And I think that's going to mean higher U.S. yields. And that's one aspect I think the market underappreciating at this point in time. And Peter, we've talked about where these could be, and healthcare is one big area you mentioned this morning. Pharma, and especially drug prices, extremely controversial in the U.S. It is,
and it was a very big point for Bernie Sanders in the 2016 election, and it has been also on the agenda for Trump, but he has focused on the foreign policy agenda against China, and there's been the tax reform, but I think 2019 probably will be the year where we'll see some potential reforms out of the healthcare system. And the Democrats, they want to be tough, and I think Trump, being a populist, he wants to be tough as well. So I think there could be some volatility going into 2019 for healthcare stocks.
And as well, on the populist front, a couple of interesting measures in specific states. You can get these specific measures passed in these elections that are local in scope. Missouri and Arkansas passing raises in their local minimum wages. I didn't actually see what that amount was, but this is a theme I think that will be growing as well and could be boosting wages across the U.S. and therefore inflation. And then finally, our final point on our chart was we think the risk here is not necessarily a Trump that is somehow caged or restrained in his style or in his aggressiveness. In fact, we think the risk tilts more towards Trump doubling down on his populist approach here to everything, including China, and I think the focus here is quickly going to switch away from this election and towards that next key event, which is this G20 meeting and the nature of the U.S.-China relationship. But I'm talking a bit too much here. Peter, on equities, also, a pretty tough slog overnight. We saw it boosted a little bit when it appeared the Republicans were pulling ahead, but then equity sort of backed unchanged.
Exactly, as you can see on the chart, it's very, very neutral, very little reaction. I think the biggest shock, as I joked this morning when I came into the office, was the big shock was the polls were actually right this time around, right? We've been used to Brexit and the US election in 2016, but looking at equities, it's very neutral. It's also neutral in Asia. We are a little bit of green in Europe. I think that has to do with something else. And actually, China was actually a little bit weak despite of this election result. So I don't think, as I agree with you, we'll swing back to the US-China trade war focus. And Hank Paulson delivered a very powerful message yesterday in Shanghai, saying that if China doesn't reform very quickly from here, we could see a divorce from the US because of diverging interest, and that could lead to a potential Cold War in the sort of the framework that we've been working with here at Saxo for over a month.
Now, Ola, before this election, we saw this move to sort of give waivers to several nations that are importing Iranian crude. Is there any big reaction in the crude markets to this election?
Well, we are actually trading low. I don't know if you can find the chart that we took with us this morning. We are trading low again this morning, as you can see here. We are really challenging some key levels of support. And if we just go back one chart, you can see some of the reason why. As John mentioned, we had the waivers, which was granted against 8 countries for over the next 6 months. Basically means that Trump is trying to cap the upside by adjusting these waivers as we go along, obviously hoping that other producers will increase production over the next 6 months in order for these waivers to be removed. But at the same time, overnight, yesterday we saw the monthly report from the EIA in the US, and you can see in those numbers in the bottom left, there's a big jump in the continued jump in increased production from non-OPEC, and that's primarily due to a surging US production. Obviously, the deregulation efforts may be capped a bit here now from the administration. Could potentially slow down the production growth, but that's not having any impact in the short term. And I think also adding to this, we had the weekly inventory report out later today, and we saw API yesterday report another big rise in crude stocks. So yes, we're having a market which is currently facing some challenge in terms of oversupply. But I think OPEC and JMMC will meet this weekend, and they're probably going to start talking about cutting supply again because they want to defend the price here down towards the 70 level.
And now there's less election pressure on Trump to browbeat the Saudis into maximizing production.
Yeah,
the angle is there.
I think he's to take into account Saudi Arabia's interest as well. I think he's probably pleased with a $70 to $80 range.
Okay. And then on the other thing, the election, we're seeing more of this on the marijuana front. We had Canada just legalizing marijuana across the whole nation. But this was also on the ballot, Peter, in Michigan. So we got another state legalizing.
Exactly, and the voters in Michigan, they went for approving marijuana for recreational use. And I think that's a big thing. If you can find the chart here, you can see that we have been sort of in almost a bubble state in August and September, early into October. We had a big surge. This is the North American cannabis index, and then we had a very sizable plunge, as you can see, in October, driven by the global rout in equities, and now we're finding a rebound. I would not be surprised to see some momentum being continued here from this the vote in Michigan. It's now the 10th state that has accepted as a recreational use, and I think it will just increase the momentum for here. So something to look for if you want to be on the long side of cannabis stocks.
And then we were also talking this morning, and one of our themes is that we do not see this midterm in any way reducing the risk of large fiscal deficits. This is going to become a galloping problem. We already have these tax reforms will feed a vastly expanded issuance of U.S. debt. And Peter, you found this useful chart showing the midterm, or not showing the midterms, but showing how the U.S. debt issue is really mounting in real dollar terms.
Yeah, this is a proprietary index created by Bloomberg. It shows you the estimated annualized cost for servicing the U.S. debt, and you can see now in October it accelerated to almost 550 billion US dollars, and you did the math very quickly, John, and it's around 2.5% of GDP.
A bit more than 2.5% of US GDP, assuming a $20 trillion economy.
Exactly, and so how does that stack up against previous records? And I did some calculations last week, and the peak was in the early 1980s, where it peaked at 4% of GDP. So 2.5% is not really high yet, but as you can see on the chart, it's almost going vertical.
Well,
so
just wait till we hit a recession and we'll see it go vertical, because that's what happens in recessions. You have expanded deficits.
Exactly, and also the Fed is quite aggressive in the short end of the yield curve, and as we talked about, the average duration in the Treasury distribution is below 3 years. So I think this chart will continue to ramp, especially also with the deficit expanding next year.
Something we've remarked on that is so odd when you have a basically flat yield curve. Why not issue a bit more at the long end? But
yeah.
They must know the supply and demand there better. And then finally on the equities, you have this. We got some fresh news this morning on BMW.
Yeah, BMW is reporting Q3, and as you know, there was a profit warning lately. And if you look at the chart here, it was confirmed. We're seeing margin pressure for BMW, so they are just will be just slightly above 7%. Their target is between 7 and 9, but on the high side of that range. I'm maybe a little bit provocative here. I'm saying that auto is kaput, and what I mean is that the German automakers have been arrogant. They're behind the curve, and I think their first slide in the investor presentation, that's the one you're seeing in the lower part, I think is a very good example of how they think in Germany right now in the car industry. They give you this expectation for electrical vehicles, but there is no timeline on this. It's just, to me, it's a lot of just marketing and just want to be presenting to investors the expectation for EV, but with no timelines. I think they are way behind the curve, and and I think that the tariffs and electrical vehicles will continue to compress margins. And I have been saying for a while, stay on the way this car industry.
And your one of your positions has been that some of their loss has been Tesla's gain, especially in the EV space.
Exactly. You can actually see on the chart that their US sales is only up 2% year to date. That's pretty respectable given Daimler is deep into negative territory, but they are losing market share to Tesla. So interesting times for the car industry.
Okay, Ole, did you want to add anything on nat gas? This is a big spike we're seeing in U.S. nat gas here on weather concerns.
Yeah, I think I talked about the inventory report earlier in the U.S. this afternoon, and one of the numbers I actually look out for is the distillate, so the diesel part, or the heating oil part is basically under some pressure because of we're seeing some cold weather coming into the U.S. and the chart here really just highlights what happens to natural gas, and we've been warning it about this for a while because we have inventory stocks ahead of the winter at a 15-year low, as you can see on the right-hand side, and basically it's left the market vulnerable to any pickup or any change in the weather outlook. And we've actually just now having a 2-week spell where it's really cold across the US, the whole of the US almost. And we saw that spike the other day. That was the biggest spike in 2 years. So we're trading around the 350 area, and it's just a warning what can happen this winter if we see colder than expected weather.
Not very elastic on the demand front when you have freezing temperatures.
Yep.
Okay, let's round it up here. We have the calendar slide for today. Keep in mind we have that crude oil and product inventory report later from the U.S. The big news up later Thursday, and very early Asian trading, the New Zealand RBNZ out announcing rates. Saw a big spike in Kiwi to the strong side as they reported a much stronger one of their earnings numbers for the third quarter, spiked much stronger than expected. Also moving yields at the front end of the curve, people looking probably for a slight shift in the language away from this two-sided guidance they've been giving previously. And Aussie Kiwi breaking down on that. We have an FOMC up tomorrow. I'm not expecting a lot there. FOMC should always be paid attention to, of course, but not expecting haven't seen any new news that makes them change their mind. And then we'll be looking at that again. The big one is the G20 meeting into the end of the month, the Trump-Xi summit, and how does the relationship shape up after that. We'll be talking more about that in coming days. So stay tuned tomorrow for another edition of the Saxo Bank Morning Call. Thanks for joining.